What's up, everyone? Welcome back again. Our current topic will be Forex currency pairs. In our previous topic, we covered what is Forex, and we said Forex is the trading of one currency to another. Now, what is this currency that we are trading, and how are they traded? So we'll start with what is a currency. A currency is a medium of exchange for goods and services. Basically, it is money in form of paper or coins, usually issued by a government, and generally accepted at its face value as a method of payment. A currency is like a Kenya shilling. A good example is Kenya shilling. It is being printed by the government, and the government is the one that is issuing them. So you cannot issue a currency um, as your own. But with the coming technology, we're seeing things like bitcoins, even though they're a bit skeptical, being used as currency. Um, they're being used to pay for a commodity or a good or a service. So it is a medium of exchange. That is a currency. There are over 100 different foreign currencies. Um, though not all of them are traded often. Reason being is that the liquidity, the strength of a particular currency, as we're going to see here further, um, the strength of a particular currency is dependent on the GDP of that particular country. So you'll find that the Kenya shilling is not that highly liquid compared to the dollar, the US dollar, or the Great British pound. So different currencies have different liquidity in terms of how fast they are moving. You find US dollar moves faster as compared to something like Swiss franc, or something compared to Japanese yen. Reason being is that the currency is being used by a lot of people. Let's break down the currencies. The euro, we said currencies, um, they are being issued by governments. Get that clear? They are being issued by governments, and the central banks are the ones that issue the currencies. So each country have their own central bank. So we're going to see that even in a block of countries like the Euro bloc, they have the European Bank. So the ECB, the Euro Commercial Bank, European Commercial Bank. So the Euro Commercial Bank is the one that issues now the euro. So we have the Euro bloc. We have the Euro currency, the US dollar, that is the United States of America. Their currency is US dollar. It is being abbreviated as USD. Japan, Japan is the country. Japanese yen is the currency, being abbreviated as JPY. We have country is Canada, and then the currency is Canadian dollar, being abbreviated as CAD. The country as Britain, United Kingdom, being abbreviated as GBP. We have Swiss franc, this is for Switzerland, being abbreviated as CHF. We have South Africa rand, being abbreviated as ZAR, this is for the South Africa. Mexico country, the currency is Mexican peso, being abbreviated as MXN. We have New Zealand dollar, country is New Zealand, being abbreviated as NZD. We have Australian dollar, country is Australia, the currency is abbreviated as AUD. That is the breakdown. Now, because we are trading one currency to another, so these countries have to be in pairs. So let's define a currency pair. A currency pair is a price quote of the exchange rate for two different countries traded currencies. Sorry, traded in the FX market. So we have one currency that is being quoted to another currency. So a good example we have US dollar being quoted against something like let's say Kenya shilling. So since trading involves exchanging of one currency, the trading is always done in pairs. A good example is Euro USD. That is the currency that is Euro. The country is the block, the Euro block. Then USD is now the United States dollar. So an example of a currency pair, we looked at Euro USD. Another example is GBP USD. We're going to cover that with you. The first currency that is being listed in a currency pair is called the base currency. Now this one, GBP USD is the base currency. The second currency is the quote currency. Now the USD. Get that clear? The first currency that is being listed in a currency pair is the base currency. Then the second currency that is being listed in the pair is now the quote currency. Currency pairs compare the value of one currency to another, the base currency or the first currency versus the second or the quote currency. This is a graphical view of a currency pair, Euro USD. Initially, we looked at GBP USD. Here we're looking at Euro USD. Um, the base currency is Euro. USD is now the quote currencies. Now here we mean for 1 euro is equals to 1.3. This is now the price. Remember we said a currency pair is a price quote. Get this clear, it's a price quote. So when you see this is a currency pair, now this is the price quote. If we head further to the charts, you're going to see now the prices, how the prices fluctuate. So the base currency is euro, USD is the quote currency. 1.32105 is now the price quote, which you have defined here initially. Let's go to the next one. Types of currency pairs. We have, and guys, if you have any question, leave it at the comment section. I'll respond it ASAP. Types of currency pairs. We have major currency pairs. We have minor currency pairs. We have cross pairs. We have exotic pairs. Most of the time, minor currency pairs and cross pairs, um, they are one. I'm going to explain this later. So let's go to the major pairs. The major pairs are um, usually the currency pairs that involve US dollar. Because remember, US dollar is the base currency for the global economy. So these are the major currency. Euro USD, that is for the Eurozone, and then United States. Um, GBP USD, we say GBP is for the British pounds, and then USD is the US dollar, so United Kingdom against United States. And then we have USD quoted against JPY, that is United States, quoted against Japan. And then we have USD quoted against Swiss franc, Switzerland. And then we have USD quoted against Canadian dollar. We have Australian dollar quoted against United States dollar. We have New Zealand dollar quoted against United States dollar. You can see the common factor here is USD because it is a base currency. It is a currently US dollar is the base currency that is used for global transactions. As we covered initially, I said for the big banks and the institutions, they want to do transactions from one country to another. Most of the time, they usually convert their local currency to United States currency, United States dollar, and then now they can transact in the form of dollar from one country to another, and then they switch when the transaction is done to their local country. Now they can convert the United States dollar now to their local currency for the purpose of using it in their particular currencies. That is for the major currencies. The common factor is the US dollar, and then for these countries are mostly the G10 countries. Europe country, Eurozone. British is a G10 country. Japan is a part of the G10 countries: Switzerland, Canada, Australia, and New Zealand. Remember, we have not listed China. Reason being is that the Chinese government heavily manipulate their currency, so it is not listed as a major player because of their manipulation. Also, it's good to note that the G10 countries they represent the countries who have the highest GDP in the world. That's why they're the major currencies. They're very liquid. So it is very easy for you to get an opportunity to get in and to get out of a trade. With a small movement, you can even get 10,000 shillings, 1,000 shillings, 5,000 shillings, or even more, depending on your risk appetite. Let's go to the minor pairs. Minor pairs, these are the currency pairs that do not include the United States dollar. They're also called the cross pairs or cross rates or crosses. At the same time, they're called the minors. So we'll have the Eurozone, we'll have the Japanese, and then we'll have the British, we'll have the Canada, and then Australian, and then New Zealand. You see now we have Euro that is being crossed against British pound, Euro being crossed against Swiss franc, Euro being crossed against Canadian dollar, like that. Um, as we're going to see further, is that these pairs, as much as they are highly liquid, there's the spread. That is something we're going to cover later. Is that we don't highly recommend on this particular currencies. However, for me, I trade GBP, JPY, and also trade Euro JPY, and also use GBP USD. Reason being is that my setup, I've found them to be profitable when I use those only three pairs. However, successful traders use different pairs. They use some are using Australian dollar, CHF. Some are using CHF, JPY. Yeah, CHF, JPY. It's a complicated pair, but yes, this one CHF, JPY. It's a complicated pair, but some traders are very successful in that particular pair. Number three, we have exotic pairs. Exotic pairs are comprised of major currencies with currency of a developing economy. Such a good example is Turkey. Um, so these pairs, I think I only traded them once. I only traded to do lira, that is the Turkish lira. I was trying to trade it during when they had issues with the United States. Um, these particular pairs, they are not heavily traded. Reason being that they are emerging markets. These are countries that they don't have the highest GDP, but they are emerging market. A good example is South Africa Rand. There are guys who are successful in South Africa Rand. And then we have the Hong Kong dollar. And then we have Euro, Turkish lira. We have United States and Norwegian krone. We have USD and South Africa Rand. We have USD dollar and Swedish krona. We have USD against Danish krone. We have USD against Singapore dollar. Um, you can find the common factor is USD. Reason being is major currency that has been accepted globally for the purpose of transaction. Then we'll find something like Euro. Euro is also a powerful country, a powerful currency because of the Euro bloc. If you combine the Euro bloc, Germany, we have France, UK as though it left during Brexit. We have so many countries within that: Italy, Spain, that is the Euro bloc. So the Euro bloc is so rich in terms of GDP. So let's look at the differences between major and minor currencies and why we choose particular either major or minor currency pair. It is difficult to see the, a major difference between the minor and the major currencies because market all is always moving on a daily basis. The market, I'm going to share something small here, we're going to say that the market moves on a daily basis. So it's very difficult to see a difference. So Let me share something briefly. I'll talk at example of GBP USD. Now this is a live market. I'm gonna put it at 30 minutes. Remove this. Now GBP USD is the currency pair. GBP is the base currency. USD is the quote currency. And now these are the prices. This is the time. We're going to cover charts later. However, let me just show you the difference. This GBP USD is a major currency pair, right? And then here we have GBP JPY, which is British pound quoted against Japanese yen. GBP JPY is a cross pair, so you can see there's very little difference. Um, there's very little difference in the currency pair between the major and the minor. Reason being is that there is price is always moving. You know, like this happened at night. This was it is happening right now. So price is always moving. So it is very difficult for you to note a difference between the major and the minor. But it is different. It is there's a clear distinction between the major or minor compared to now the cross pairs. Let's look at USD against lira. Uh, it is TRY, that is USD against Turkish lira. Now this is how it looks. You see, with a small movement like this, it's very difficult for you to make a prediction, to make a speculation of where the market is heading. Therefore, it is these pairs. Some guys are trading, but they're not heavily traded because the liquidity it is not as much as compared to the other pairs. If you look at another one, USD against you can use against Norwegian krone. USD against Norwegian krone. Norwegian krone is NOK. Yeah, as much as there's no that much difference, but they're going to see there's going to be a difference in terms of now spread. Yeah, that is the charge that you're being charged by the broker. Now let's move ahead. Major currencies. The major difference is that the major currencies. Let me share the notes. Yes. Now the major currencies they are more liquid in the market. The spread is tighter. The spread is small. The swap rate is lower. The swap rate is the charge that your broker is charging you for holding a trade more than a day. Then for the minor foreign currencies, there is less liquidity, and then the spread is wider. Especially this is the major difference. The spread is wider, and then also the swap rate is higher. That is the charge that your broker is charging you for holding a trade for more than a day. So that is it for the currency pairs. Our next topic is forex terminology. If you have any question, you can WhatsApp the number that is being provided and also comment on the comment section. We'll get back to you. You're also welcome at our DMD office. We do live trading and also training. See you in the next video.